investors, welcome to Proceemo, the value stock analyzer. Today is November 14th, 2022, and this week's featured stock needs no airbrushing to its fundamentals because its revenue is as consistent as the millions of people who try and pirate their software. I'm talking about Adobe, the famous maker of Photoshop and Illustrator. Are these tools enough to make Adobe an attractive stock to own? You will definitely want to stay tuned to the end of the video to find out. Adobe is full of interesting surprises. Don't forget to like and subscribe. Your support will help us continue making content for you. Before we jump into the numbers, a little bit about Adobe first. Adobe is very commonly known for Photoshop and Illustrator, tools used to make images for things like YouTube videos and anything where digital graphics are required. Adobe makes a lot of other media tools too, though. Things like Lightroom for photos, Premiere for video editing, user interface and user experience tools, so on and so forth. These tools are known as the digital media segment, and as you can imagine, they make up a large portion of Adobe's business. On the other side of the business, Adobe has the Adobe Experience group. Adobe Experience includes tools for enterprises, specifically Adobe Experience Manager. Adobe Experience Manager, also referred to as AEM, includes a suite of offerings for businesses in the way of content management systems, digital asset management, cloud services, digital learning, and digital guides. What does all this mean? Basically, if you are a business and you need tools and services to manage your digital presence, Adobe can service for you the full stack of tools to manage your website and even your digital offerings to your end customers. Adobe can be your entire digital presence, which, if you are running a business in 2022, is a pretty big deal. Those two businesses make up most of the business that Adobe does. Now that we've gotten that out of the way, let's jump into the numbers. Adobe is trading at $341.15 today. Have they been impacted by the recent economic turmoil? They absolutely have been. A year ago, Adobe was trading at $688, almost 50% higher than today's price. The whole market being down is going to hurt most stocks, but let's dig into revenue and earnings and see how justified this drop is. Let's start with revenue growth over the last couple of years. 22.67% between 2020 and 2021 seems pretty decent. It is worth pointing out that Adobe will be releasing earnings in mid-December, so we can revisit this stock in a couple weeks and see how they did from the previous year. From 2019 to 2020, Adobe saw 15.19% revenue growth and 23.17% growth the year before that. That gives us a 3-year average of 20.52%, which is solid. Earnings tells us a different story though. From 2020 to 2021, we saw a decrease in earnings of minus 8.33%. That is interesting. The year prior, we saw a 78.22% increase in earnings. Wait, what? 78.22%. That's not a typo. We're really going to need to look into earnings and see what caused that big jump. Prior to that, 13.92%. Okay, so when we have a huge jump like this, we need to investigate because either their business is wildly inconsistent, they had a change in accounting, or maybe some serious expense that year. It takes some digging, but the reason for the drop in net income between 2020 and 2021 is interesting. We need to take a look at the income statement to understand why. Adobe has a nice revenue increase between 2020 and 2021, almost $2.9 billion. More revenue in 2021. And we see operating expenses also went up by $1.2 billion. As we keep dropping down, we see our pre-tax income is $5.7 billion in 2021 versus $4.1 billion in 2020. But then we see the Adobe tax bill. It looks like they actually had a tax credit in 2020 of about $1 billion compared to a tax bill of $883 million in 2021. And this is the reason for the drop in net income. Very interesting. There are other indicators that we can use to really take a look at the Adobe business without taking into account taxes, and we'll take a look at that in just a little bit. Coming back to our analysis, the Adobe 10-year earnings growth average is 32.93%, which is impressive. Now let's compare against our implied growth model. Implied growth is a calculation that tells us how much growth is baked into the stock price based on its earnings today. Implied growth is not a crystal ball. It is merely a measure of the current stock price compared to previous earnings. As always with any investment, past performance does not tell us future results. Adobe's implied growth is 10.49%, which is low compared to actual earnings. Let's not forget to point out the stock is down almost 50% over the past 12 months, and if the stock were back at $688, implied growth would be much closer to 30%. Right about where their earnings growth has been for the past 10 years on average. Does this mean Adobe is trading at a massive discount right now? Well, not too fast. We still have more work to do. Let's go to the scorecard. Implied growth over actual 5-year growth is 0.29. We say a ratio of 1 is a fairly priced stock, over 1 is an overpriced stock, and under 1 is a potential deal. Adobe is well under that 1 at 0.29, so a positive indicator to start. I am still wondering why such a massive drop in that price, but let's continue. Liabilities over assets. Our ratio is coming in at a healthy 0.46. We say between 0.3 and 0.6 is a good spot. Adobe is comfortably in the middle. Steady dividend is not available. Adobe used to pay a dividend, but suspended distributions back in 2005. So we can skip dividend ratio as well because there are no recent dividends. Market cap to revenue ratio, our revenue multiplier. We're nearly at 10x. Adobe generated $15 billion in revenue in 2021, and their market cap is about $153 billion. 10x is a decent multiplier in tech right now. We were seeing 20, 30, and even 40x multipliers as recently as a year ago when tech stocks were wildly inflated. So seeing 10x right now is actually pretty refreshing in my opinion. Adobe does have 5 years of increasing revenue. We don't have assets greater than 120% of market cap. We've talked about this a couple weeks ago with Microsoft. It's really uncommon to find a tech company where this is true. I would challenge anyone listening to actually find one, and if you do, please put it in the comments below. I will be blown away. Adobe's 3-year revenue growth is greater than its 10-year revenue growth. This is a positive sign that they have some momentum in increasing their revenues. Increasing revenue growth for 3 straight years is false. This is tough. We've mentioned before in previous videos, this is not a concern to me that Adobe does not have this box checked. 5 years of assets greater than 150% of liabilities is surprisingly true. This tells us that Adobe is unbelievably fiscally responsible compared to its peers, because this is just not true for most tech companies that I look at. So good for you, Adobe. Finally, revenue per employee coming in at $607,000 per employee. This seems okay. Compared to Microsoft from a couple of weeks ago, this is about $300,000 less. Now, Microsoft and Adobe are not apples to apples, even though they are both in tech. I do like to compare tech companies to other tech companies. We don't have a magic number or ratio here anyway, so I'm not going to draw too many insights from this. I do wish it was a little bit higher like Microsoft's though. We finished our Proceemo scorecard analysis. Where does this leave Adobe? Well, to be honest, I'm not 100% sure how I feel yet. On one hand, average earnings growth is good, but it was inconsistent, and the stock price is down 50% year over year. Do other investors know something that I'm not seeing here? Sometimes I get to the end of a scorecard not knowing how to feel about a stock, and this is one of those cases. I need to see a couple more trends to form an opinion, so let's go to the charts. Revenue looks great, solid over the last 8 years, constantly increasing. That looks cool. Earnings looks mostly positive. We do have that drop between 2020 and 2021, so no real surprises there. And remember, net income is for all outstanding shares. Earnings per share is net income divided by all shares. So they're the same thing under a different lens, and this chart looks exactly the same. We have our assets and liabilities growing in tandem. Some folks get a little turned off by growing liabilities, but this is really normal, especially over the past few years where borrowing money was so cheap. And now that we're seeing interest rates go up, we might expect to see really strong companies start slowing their liability growth, maybe even declining liabilities until rates drop back down. But as we saw from the scorecard, their assets are greater than 150% of their liabilities over the last 5 years. Liabilities are the last concern I have for Adobe right now. Finally, the thing I really wanted to see, EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. Essentially, this is like net income, but does not include capital structure and the tax situation. EBITDA is generally viewed as a stronger indicator for a company's profitability because it looks at its core earnings structure and not all of the externals impacting the company balance sheet like taxes and capital structure, as we said earlier. And with that being said, Adobe's EBITDA chart looks really decent. We pointed out earlier that the drop in earnings had to do with the tax situation on Adobe's income statement, and despite that situation, Adobe's earnings potential continues to grow year over year at a really healthy rate. This is great. Adobe has thrown me for such a loop here that I actually added a couple of new features to Proceemo so we can do a deeper dive. First is key metrics on our fundamentals page. I really wanted to see free cash flow per share and its performance relative to previous years, because this tells us how much cash the business has left over per share after its operating expenses. And we can see here Adobe has a nice steady increase in free cash flow year over year. I also added enterprise value, which is a common calculation for determining a company's actual value compared to its market cap, which is based on its perceived value by the street. Here we see enterprise value is at $271 billion compared to a market cap of $153 billion. This alone suggests that we're underpriced at the moment. The last feature I added is institutional owners. Now, there are two schools of thought around institutional ownership. The first being that if a stock is good enough to be owned by institutions, then it is good enough for your hard-earned dollars and should be taken seriously. The opposing school of thought, from the legendary Peter Lynch of the famous book One Up on Wall Street, argues that if institutions got their hands on the stock, then a lot of its growth is over because institutions are only going to invest in safer stocks. I am a really big fan of Lynch, therefore I do like finding stocks with lower institutional ownership when I'm looking for high growth stocks. If I'm looking for more blue chip stocks, then I want to see more institutional ownership. We can see on our current quarter ownership is at 24%, but the same period a year ago, it was at 80%. Wow, what a jump. When we scroll down and look at the pie charts for top owners for quarter over quarter, we can see the Vanguard Group sold off its shares, as did BlackRock and State Street. This is a massive drop in institutional ownership, and it does give me a slight bit of concern. What do these institutional investors know that we don't? So where does this leave Adobe? I need to state first, I am biased. I really like Adobe products. I do a little bit of photography, so Lightroom and Photoshop are essential tools on my laptop and tablet. Looking at Adobe objectively, I do like what I see, to be honest, but I want to see more data. The drop in institutional ownership from the most recent quarter has me a little spooked. I don't currently have a position in Adobe, and before I open one up, I would be comfortable waiting for the next yearly earnings report. Adobe's fiscal year ends in just a couple of weeks at the end of November. I'm not one who times the market. I'm not trying to buy in now with the worry that it might jump after the next earnings report. If their report looks favorable and the stock jumps up 10%, that's fine. I'd rather wait and see how those numbers look rather than risk going in before those earnings are released. This is value investing at its core. We don't time the market. We make intelligent, data-based decisions when it comes to investing our money. If you really want to get ahead of the yearly earnings report, you could look at quarterly earnings. They look similar to previous quarters for Adobe. However, we will still be left with the question, why was there such a massive drop in institutional owners? That's it for today. Please like and subscribe if you found this helpful. And if you really want to support the channel, please go to Proceemo.com and subscribe to our monthly service to see analysis like this just for yourself for only $5 a month. If you have a stock you'd like to see featured next week, please comment below. Thank you, happy investing, and go find some value.